Every single day, trillions of dollars appear and vanish from a number on a screen. And almost nobody can explain exactly why. The question that haunts every investor, every retiree, every person with a savings account is this: what actually moves the stock market? Let's build the answer from scratch. A stock is just a tiny slice of ownership in a real company. When you buy a share of a company, you own a small piece of its future profits. Now, the price of that share is not set by the company, it's set by people. Specifically, it's set by the last price at which a buyer and a seller agreed to make a trade. That's it. The market price is just the most recent deal two humans made. So the real question becomes, what makes buyers want to pay more, or sellers want to accept less? The answer is expectations. Not what a company is worth today, what people believe it will be worth tomorrow. Think of it like buying a house on a street where a big new park is rumored to be built nearby. You'd pay more for that house today, even though the park doesn't exist yet, because you expect the future to be better. Stocks work exactly the same way. When people believe a company's future profits will grow, they compete to own a piece of that future, and the price rises. When people fear those profits will shrink, they rush to sell, and the price falls. Now zoom out to the whole market, thousands of companies at once. The entire market rises when most people, collectively, feel optimistic about the future of the economy. And it falls when fear spreads. Fear and optimism travel fast. A single news headline, a war, an interest rate decision, a disease outbreak, can shift the mood of millions of investors in minutes. Here's where it gets wild: sometimes the market moves not because anything real changed, but because people believe other people are about to panic. Imagine a crowded theater where someone near the exit starts walking fast. Even if there's no fire, others start moving too, and suddenly everyone is running. Markets do the exact same thing. A sell-off can feed on itself purely because traders see other traders selling. Interest rates add another powerful layer. When borrowing money is cheap, companies grow faster, consumers spend more, and investors feel bold enough to buy stocks. When rates rise, borrowing gets expensive, growth slows, and suddenly keeping your money in a safe bond sounds smarter than owning a risky stock. So demand for stocks drops, and prices fall. There's also a deeper, slower force at work. Over long stretches of time, economies grow, companies earn more money, and those earnings push stock prices steadily upward. That's why, despite every crash in history, the long-run chart of the market looks like a slope climbing to the right. So here's the thing to hold on to: the stock market isn't a machine measuring the present, it's a mirror reflecting millions of people's guesses about the future.